Morning, everyone.
Good morning.
Good morning. Welcome back. This is the Teachers Retirement System of the City of New York Investment Meeting for September 6th, 2018. Patricia, would you please call the roll?
John Adler.
I am here.
Thomas Brown.
Here.
David Kazansky.
Present.
Lindsay Oates. Deborah Penny.
Here.
Susanna Vickers.
Here.
We have a quorum.
Great, thank you very much. Okay, so let's start in our public agenda, and I'll turn it over to Michael to do our performance report.
So maybe we'll start off with the ancient history of the fiscal year ending June 30th, 2018. So if everyone wouldn't mind the larger book that was handed out, if we could turn ahead to tab 5. Behind there is page 21. Let everyone turn there. We'll go through at a high level the fiscal year results for the passport funds. Okay, so at the end of the fiscal year ending June 30, 2018, you can see at the top of the page the Diversified Equity Fund had assets of about $15.6 billion. The fiscal year-to-date return under the one-year column there for the fund was about 12.1%, compared to the hybrid benchmark at about 12.8%, 14.8%. So I think the biggest takeaway here when we look at these results for the fiscal year was the best place to be last year was in U.S. equities. And that plays out not only in terms of the performance of the underlying pieces of Variable A, the Diversified Equity Fund, but also when you look at some of the returns for the other options. There was also some relative performance detraction from active management within the U.S. portion of the Diversified Equity Fund as well as the defensive portion. But what really drove the absolute returns of the fund here, you can see, was the large allocation to U.S. equities being up about 15% last year. Non-U.S. equities returned about half that last year, with about 7.4% return for the international composite of Variable A. The defensive composite could not keep pace with the broad equity markets, as we wouldn't expect it to. That returned about 6.7%. That lagged its respective benchmark by a few percentage points. That benchmark was up by about 11% last year. And then I mentioned the relative performance of the active U.S. equity strategies. That composite was up about 12.9%, and that lagged Russell 3000 by about 1.9%. Some of the active management within the international composite did contribute to positive relative results there. For the balanced fund, you'll recall that fund was incepted on January 1st, 2018. So we have a 6-month return for the fiscal year there. That fund was down about 40 basis points and lagged its benchmark slightly by about 20 basis points. Assets there have been somewhat static and continue to be around $380 million. For the International Equity Fund, you can see about $155 million in assets as of fiscal year end. That fund last year was up about 7.1% ahead of its benchmark, which you'll recall is comprised of both developed and emerging markets. I'll make a quick comment there. For the fiscal year last year, developed markets were up about 6.8%, and emerging markets were up about 2.7%. So emerging lagged not only for the fiscal year as a whole, but also quite a bit so far year to date, which we'll talk a little bit more about later. As far as the Inflation Protection Fund, assets there of about $65 million. The fund last year returned about 5.1%. That was enough to exceed its custom benchmark by about 1%, as well as CPI, which was about 2.9% for that 12-month time period. The Socially Responsive Equity Fund, with assets of about $205 million last year, you'll recall this strategy is focused primarily in the large cap U.S. equity space. That fund returned about 13% last year, and that lagged the S&P 500, which was up about 14.4%. So we're going to talk a little bit more about more recent results with the July report, but I'll pause there and see if there's any questions on fiscal.
Any questions? I have a couple of questions.
Sure.
So the first question is, did I hear you right to say that on international, developed markets were up about 6.8 and emerging markets were about 2.7 or something like that?
That's right, and the 2.7 refers to the custom emerging market index.
So how is it that the composite is up higher, the composite benchmark's up 7.04, that's higher than either of those, isn't it? Made up of those two?
It's actually a mix of the underlying components passive benchmark. So it's, if you look at the international composite, which there's more detail on page 24, on the second half of the page, the composite there is actually made up of the individual strategy benchmark components.
Both growth value and so on.
Yeah, absolutely. So that's
Okay.
a great point though, John. So growth, and this has been an overarching theme we've seen not only in the US over the last 12 months, but also in non-US markets. Growth has significantly outperformed value. So at a high level in the US, the growth index last year was up about 22.5%, and the value index was up about 7.5%. And then in non-US markets, you can see the EFI growth was up about 9.8% versus value of about 4.9%. What also helped contribute to the relative returns there, John, was the inclusion of international small cap, which you can see was up over 10%.
Mm-hmm. Okay. Then one other question, and maybe you'll go into this more. So typically, the lag between the defensive strategies composite and its benchmark has not been as great as it was this past year, where it's over 400 basis point lag.
Yep.
And I recall that we actually switched up the defensive strategies this year to try to, because it had been lagging in these kind of bull markets, and so we changed it to try to capture more of the upside.
Yep.
And yet, in an up year, a substantially up year, it apparently underperformed more. Could you
Sure.
briefly explain that?
Absolutely. So there were a few things going on there. The first being poor relative results for the active managers within the composite.
Mm-hmm.
So there's more detail for that on the top half of slide 24. And you can see that on a relative basis, the managers there generally lagged across the board, or I should say lagged across the board relative to their respective benchmarks.
Mm-hmm.
What we've seen from these managers is that they've actually been a bit more defensively positioned relative to their, especially for the TAA type strategies, relative to their stock bond mix. They've been underweight US equity, which has not helped them. As far as the other thing that we did change last year, which you might have noted, was increasing to a certain degree the allocation to convertibles within this composite and the convertible strategy itself. So when you look at the track record for one of the convertibles managers there, you'll note that they have a longer term track record that links both the conservative strategy you noted we were transitioning from,
Right.
as well as the strategy with a little bit of a higher equity sensitivity. So if you look at that particular manager, you'll see the last 6 months is really more representative of the new strategy that they've moved to there. And in that case, convertibles has actually lagged to a considerable degree the equity market returns over the last 6 to 12 months. So that's something else that's caused a lot of the overall, I'll call it the general tracking between the defensive composite and the overall US equity market as well. So not only are we concerned and always looking at the relative returns for each of the managers, but also how is the overall composite tracking to the Russell 3? Because we do want a good amount of upmarket participation.
Yeah.
In a 15% upmarket, it's been really hard to keep pace. So that's a very good point.
Footnote. I mean, it's a function of the nature of the market that we've been living in for the last 6 to 12 months, which is probably used an overused term, but it comes up over and over, over maybe every once in 10 years at least. It's a very narrow market, meaning that not only did U.S. equity outperform every other market on the planet, but even within U.S. equity, as Mike noted, growth stocks massively outperform value stocks. So if you didn't own a disproportionate share of large cap growth stocks, which none of these strategies owned, none of the defensive strategies owned, you were destined for single-digit performance, and at best, what you see is like a 6% number for your defensive strategy. So that's, given the nature of the market, there really was nothing that you could buy other than large cap growth stocks in the U.S. that would have given you double-digit returns. So there was no way that these strategies could have kept pace in the market like we've been living through the last 6 to 12 months. And I think that's just, there's no other strategy other than large cap growth. Now, if you have an S&P, half of its growth, half of its value, you did get double-digit returns. So hopefully that makes sense. I think that's just the very simple truth of what we've been living through over the last year or so. Does that help?
Yep, thanks. Any other questions for Rokaton on the fiscal year report? Okay.
So on the July performance report, that's the separate handout. You'll note the diversified equity fund assets exceeding $16 billion. The first month of the fiscal year, particularly again for U.S. equities, was a strong month. The U.S. market was up about 3.3%. The diversified equity fund as a whole was up about 3%. Non-U.S. markets during July were able to do a better job keeping pace with the U.S. Developed markets actually year-to-date through July have been down by about 36 basis points in U.S. dollar terms, and emerging markets are down about 4.7% in U.S. dollar terms. I make that comment because we're going to be talking a little bit more about foreign currency later today. If you look at those numbers in local dollar terms, the EFI's negative 0.36 return in U.S. dollar terms is actually a positive 1.65% in local currency. And the EM, which I mentioned, down about 4.7 in U.S., was down about 1.2% in local currency. So dollar strengthening has certainly been something that has had an impact on absolute numbers here. As far as the relative results, year to date, the diversified equity fund has lagged the hybrid benchmark by about 20 basis points. And I commented earlier on some of the relative performance of the underlying composites there. Modest positive contribution from the international portion, and some lagging on the U.S. side and the defensive composites, just defensive strategies composite rather. The balanced fund for the first month of fiscal 19, that fund was up about 80 basis points, roughly in line with its benchmark. Year to date, that fund is up about 0.5%. The international equity fund, 160 million in assets. I mentioned the stronger month for non-U.S. equities. That fund was up about 2.7% in July. Inflation protection fund, that fund had a negative return for July. Calendar year to date, that fund is up about just shy of 1%. And the socially responsive equity fund, that fund was up about 2.6%, lagging the S&P, which is up about 3.7%. So year to date, that fund is up about 7%, which is about 50 basis points ahead of the S&P.
Big questions on July.
More ancient history.
Okay.
There's the August report. Very quickly, there the U.S. has continued to do well. August, the Russell 3 was up about 3.5%, bringing the calendar year to date return for the U.S. to about 10.4%. So the rally continues to be strong. On the international side, the composite benchmark there was down about 1.9%. For the month of August, developed and emerging markets were roughly in line, both down by about 1.9%. The defensive strategies composite benchmark up about 2.6%, and all told, the hybrid benchmark up about 2.3% during August. The balanced fund benchmark was up about 60 basis points in August. Both positive contributions from the equity component and the fixed income component there. I commented earlier on international. And then as far as the underlying strategies for the Inflation Protection Fund and the Socially Responsive Fund, both with positive returns for August and positive returns year to date. I'll pause there.
I don't think there's any questions on August either. Thank you. So next item is the foreign exchange hedging
Yes.
discussion.
And we have Mike Haddad and Miles Draycott from BAM here to present some information that was presented at a summer seminar to certain trustees, and we just wanted everybody to have the same information. If you don't mind taking one and passing down. Sherry, do you mind, can I ask you to move down one?
Yeah. There's Sherry. And then down. Thank you.
Look right.
Uh-oh.
Do we all have a hand up?
Yeah.
So we're going to try and, this is an educational seminar on FX hedging without a recommendation. And we're going to try and accomplish three things with you this morning. Is show that there's no excess return from having assets denominated in foreign currencies, that there's increased volatility in your portfolio to do so, and that an FX hedging strategy is relatively simple to do, though there are several key considerations if you make the decision to go forward with that. Miles and Nick have done a fantastic job with this. I'm going to let them handle the quantitative and technical part of it, and I'm going to do the simpler part of it.
Nick, do you want to come sit up at the table too? No, because I actually have heard this before, so I could go sit across over there. I think that makes sense. Come on, if you're going to talk.
Do you want me to do it?
Yeah.
That might be helpful.
It'll,
You're in the hot
If
seat.
something complicated comes up, I can ask.
I can sit next to counsel.
Anyone else?
I'm pretty sure he's good. He helped write most of it.
Does
So why don't we
everybody, I'm sorry, does everybody know Nick?
So why don't we flip to background, and just a reminder that your portfolio is currently invested in foreign currencies, in your equity portfolio, and also in a few different investments in your private markets portfolio. And the policy that to date you have and all other four systems have is to not hedge your foreign currencies. And as a reminder, that was a decision you made as part of your strategic asset allocation. So when you approved an international equity portfolio, both EFI and EM equities, it was an unhedged portfolio. So the policy of not hedging is consistent with your strategic asset allocation decision that you guys made in the fall of 16. And the question that we've posed to ourselves, and that we're drawing you into the debate, is it appropriate to not hedge foreign currencies? Given what we're going to try and show you, you get no excess return from doing it, and it adds volatility to your portfolio. And then lastly, as a reminder, all of your liabilities are denominated in dollars. So that's the backdrop of which the question that we're challenging ourselves with and trying to come up with an answer to that. So if we flip to the next page, this is a snapshot, I guess as of the end of July, of all five systems combined. That being said, your portfolio is very similar to this, and across the vertical axis is the different currencies in your portfolio, and across the horizontal axis is the different asset classes. And I would draw your attention to the first column, which shows you that roughly 19% of your portfolio is invested in non-dollars, and that of the great bulk of that is in the international equity portfolio, where 18.43% of that 19 is invested in foreign currency. So what we're really talking about here that's important is your developed market international portfolio and your emerging market equity portfolio. Those are the two things that count. You can see some of the tag ends in the different private markets where you have exposure to non-dollars, and they, while they exist, they are extraordinarily small relative to the other ones. So what we're really going to focus on is public markets. So with that, I'm going to turn it over to Miles and Nick to walk through, the three objectives that we laid out and that we're going to try and talk about. And then the other thing I'll just say is please interrupt with questions along the way so we don't get too far along.
Yeah, I can't emphasize that enough. This is, please, to the extent this devolves into a discussion, that's positive. So on the next slide, I basically reiterate what Mike's saying. We've looked at some of the literature and our own analysis, investigating what the expected return from what I'm going to term passively accepting FX risk is. What I mean by that is investing in the market, the global stock markets, without making a conscious decision as to which currencies in which to take exposure. If you just take that, we've looked at the consequence of just passively taking that FX risk and concluded that the likely return is very close. The FX component of the return is very close to zero. That being said, exposing the system to that FX exposure does increase volatility. So you're not being compensated for taking risk is kind of the punchline of this analysis. And we'll go into some more detail on that. So the consequence of that observation is that we think by hedging, it would be possible to construct a more efficient portfolio. And what I mean by more efficient is same level of risk, higher return. That's the sort of a punchline, if you will, that we hope to get to. So the next slide, and the first one was graphs, so that's 5, I think. We look at the EFI hedged returns. So this is not your portfolio. This is the EFI index. Just looking at the EFI index, we compared the cumulative unhedged return with the cumulative hedged return. So 100% of every currency exposure is hedged, is what we mean by hedged returns. It's totally passive, just 100% of the exposure is hedged. And in the bottom, you see the difference between those two lines. So that line on the bottom is essentially the currency return. And you can see, in actually looking backwards over this interval, in anything to do with FX, it's important to stipulate it's over a particular interval, because choice of interval can change the conclusion. But over this interval, you see that actually the contribution to the return from currencies is actually negative. So that's the first observation. Over this period, comparing hedged to unhedged returns, the difference is the currency contribution, and over this period was negative. And then we try and do the same analysis on the following page, but here rather than looking at cumulative returns, we're just looking at annual returns. Okay? We're just saying, comparing the hedged versus unhedged return of the same index, MSCI, hedged and unhedged. And again, the difference is the value added, which is on the bottom panel, the value added of hedging. So we see that on average, it increased the return to hedge. And the average difference between 1-year returns over this period, the average difference between the hedged and unhedged returns is about 49 basis points. So that's kind of the return argument. Here, the next page, we do the same thing. But now we're looking, again, by the same thing, I mean, we look at the same two indexes over the same interval. Rather than looking at returns, we're looking at 1-year volatility. And here we observe, we look at the hedged versus unhedged volatility. And again, on the bottom panel, we look at the difference. Okay, so that shows the reduction in volatility as a result of hedging. And on average, we know that there's a line through the bottom panel is the difference, and the line across the graph is the average value. So on average, over this period, 1-year volatility was reduced by about 225 basis points. So a fairly significant reduction in the volatility of this segment of your portfolio. You invest in something very similar to this. This is the index, not your actual holdings.
And Miles, that reduction is on the EFI portfolio itself?
Yes. Yeah, it's just what the reduction of the EFI index would be if you hedged the currency exposure.
So, Miles,
We're going to get to looking at your specific portfolios shortly. Sorry.
okay. So on the previous page on 6, when you say that the annual returns have a 49 basis point improvement on the unhedged portfolio,
Let's get versus the unhedged.
versus the unhedged, right? Then that would really only reflect the 19 or so percent of our total portfolio, right? So we're not seeing a 49 basis point improvement in the entire portfolio, just in the 19%.
Absolutely. And what we're going to get to on the next few slides is basically increasing the denominator. So first of all, we're going to shift to looking at your portfolio, not an index. And then we're going to look at the impact on just that section of your portfolio, then all public market, then all public equities, all public markets, and then the total plan.
Okay, great.
And isn't the answer to his question, it's not even 19%, it's only the EFI, it's not even the EM.
12.
So it's
Oh,
equal to
Sorry,
12.
I didn't.
Thank you.
Two colleagues are absolutely right. We're not, well, yeah, and we'll get into why we think it probably only makes sense to hedge the exposures in EFI versus your EM exposures in just a minute.
Okay, great.
So the last series, the last slide in this series of slides, so comparing the EFI index with the hedged versus unhedged EFI index. This is the page 16. Page 8. So here we look at what the change in the Sharpe ratio is as a result of the ex-ante. So looking backwards, what the change in the Sharpe ratio was as a result of hedging. And we note that the impact of hedging, the FX exposure, fairly materially increases the Sharpe ratio. So an improvement in the Sharpe ratio is saying that we're improving the risk-adjusted return. That's what a Sharpe ratio is indicative of. Or, more positive is better. And this increases the Sharpe ratio on average by 16 basis points. It's a one-year Sharpe. We're just comparing, excess return between the index and the risk-free rate. So on the next slide, just an observation. We've used the MSCI risk system to do much of this analysis, and we've been discussing with Rotan, far from coming to conclusions, how it can be used to produce a set of exposures or risks that should be hedged. And they're sort of, the objective of the analysis is to identify the exposures that it would make sense to hedge without too negatively impacting the return. So it's basically set up an optimization problem in the borrow platform. So I want to step back on the next page just a little bit. This is page 10 now, and please interrupt if I'm kind of going too fast. I want to mention that in any consideration of hedging currency exposure, you really need to think about two very important considerations. And one of them is, well, what's the correlation between the FX rate that you might hedge and the portfolio returns? So is the correlation between that FX rate positive or negative? If it's negative, it's actually desirable. And what that's saying is it helps to diversify the portfolio. And this was actually the original assumption that maybe wasn't articulated perhaps at the time. The assumption of negative correlation was assumed that it's previously assumed until like 10 years ago that the foreign exchange exposure actually helped to diversify. All foreign exchange exposure helped to diversify the portfolio. And the changes that thinking has moved along is saying, well, wait a second, some of these exposures are not helpful. And that's really what we're here to talk about today. So the two considerations are positive or negative, and obviously you can't know the perfect, you can't, with the ability to foresee the future, you wouldn't hedge negatively correlated currencies. So if you believe it's possible to develop an expectation as to the correlation between the FX rate and the returns of the portfolio, then you wouldn't hedge negatively correlated currencies. The other very important consideration is, well, okay, hedging reduces vol, but the cost of hedging reduces return. So in the case of EM currencies, we think that the bid offer, and we modeled the bid offer in the analysis that we implemented in the risk system. We looked at the bid offer in FX forwards and concluded that in the less liquid FX markets, namely most of the emerging market currencies, probably the cost of hedging is too high. It would negatively, the benefit in the reduction of volatility is outweighed by the drag on returns that you would incur as a result of the transaction costs of hedging. And the next slide is somewhat repetitive. The object of the exercise is to identify the currencies that are expected to be negatively correlated and identify the currencies where the cost of hedging would outweigh the benefit. So finally, we turn to basically David's question from earlier, which is, well, okay, what's the impact on this section of our portfolio? What's the impact on the public equity portfolio? What's the impact on the entire public markets portfolio? What's the impact on the entire portfolio? So we go from kind of the most granular, and we basically increase the denominator over the next couple slides. So the first one, we just look at the impact of hedging the FX exposure of the EFI equity, your EFI equity portfolio. We're no longer looking at the index. Okay, the impact of hedging your EFI portfolio on that portfolio. So just the reduction in risk and cost of hedging with currency exposures in that portfolio. And we noticed that it reduces risk by about 98 basis points and increases return by about 80, and would increase return by about 80 basis points. We do exactly the same analysis, except now we do employ the MSCI risk system to say, wait a second, which currencies do we expect to be negatively correlated? And it turns out the only one that it expects to be, of the EFA currencies, that expects to be negatively correlated is yen. So if we decided not to hedge yen, this is looking backwards with perfect knowledge as to what the negative correlation of the yen was with the portfolio. We see that we would have reduced risk by 165 basis points and increased the return of your EFI portfolio by 137 basis points.
Can you walk through the methodology that you use to show the potential increase in return?
Yes, I will. That's a good point. I did want to get to that. So the whole thesis here is that by hedging, you can create a more efficient portfolio. So again, by more efficient, we're saying same level of risk, can you generate more return by hedging FX? So that's the question we're posing. And so the theory here is, well, okay, if we reduce risk by hedging, we should redeploy that risk appetite into an asset class that is expected to generate a positive return, rather than just having an exposure to FX, which is expected to generate a zero return. So in order to do the analysis, we didn't want to choose the risky asset class that would be expected to generate the positive return. We could come up with any result we wanted if we, guessed at what the return was going to be. So what we did is we said, well, rather than do that, what's the most most objective way of dialing risk back up? So if we're reducing volatility, we want to look at this portfolio, but increase the risk back up to where it was before we hedged. So the simplest mechanism for doing that is, I'm not suggesting we use leverage. This is just a way to perform the analysis. We just looked at levering the portfolio so that given the same asset allocation, we increase the risk back up to the level of risk that was in place before hedging.
Just to be clear, I don't even think we're permitted to do that, right? Just to be clear.
We could get into an argument about that. What's sec lending? I mean,
Don't go there.
never mind. Ignore that remark. Ignore that remark. But we're not suggesting using leverage. This is just a mechanism.
I understand.
So that it relieves us of saying to you, well, if you invest in this asset class.
But couldn't you, let me just ask you a question to get to that same goal. Couldn't you simply increase your exposure to the equities that you're hedging the currency risk in order to
Absolutely.
that
But
same result?
the only reason we chose to use this mechanism, talking about using leverage to dial up the risk, is we didn't want to make the subjective argument that all of the new risk appetite could be used to invest in EFA equity.
Okay.
We just wanted to say, suppose you just dialed up the whole thing, given your
Across the
current asset
portfolio.
allocation.
Yeah, okay.
We just thought that was the most objective
All
way
right.
to do it.
And very simply stated, if you reduce risk, that's a good thing in and of itself. But if you redeploy it into something else in your portfolio, then you get extra return. And that's the benefit to your portfolio of hedging your foreign currency exposure.
Just have to redeploy in the right place.
Exactly.
But that's exactly the point. We didn't want to tell you.
Redeploy in the wrong place.
We didn't want to say we know how you should redeploy it. We said you stick with your current asset
You don't want to
allocation.
say that. You know it. You just
No, I know. Oh yeah, it's all private equity. I didn't want to make any pronouncement about where the risk should go. Anyway, so going back to basically answering Dave's initial question, which is, okay, this is positive for the TRS EFA portfolio, but what about the whole ball of wax, right? So we're going to dial up in terms of granularity here. So on the next page, we look at, again, this is just hedging the same exposure, the TRS, the FX exposure embedded in the TRS, the EFA equity portfolio. But now we look at the reduction of risk on the entire public equity portfolio. And here you see a 26 basis point reduction in risk, corresponding 20 basis point increase in return. That's if you hedge everything. If you exclude the yen, and again, this is looking backwards, the reduction in risk is about 38 basis points, and the increase in return would be 29 basis points. So hedging the same thing, but increasing the, looking at the impact on a larger, bigger denominator. Okay?
And if you think why that intuitively makes sense, your EFI portfolio is 12% of total, then add in US and add in EM, and now it's 50% of your total portfolio. That's so we're measuring the reduction in vol over now 50% of your portfolio.
And so that, sorry, the potential return increase, that is across the equity portfolio, the 50%, or across the whole 100% of the portfolio?
This slide, it's now just the equity portfolio.
So
what we're doing, John, we're going from the increase in return on
understand.
just TRS EFA,
Yeah.
TRS public
Whole
equity, TRS all public markets, TRS total plan. That'll be the last of
I
these
get
four
it. You're going to
slides.
go through all that.
Yeah,
Okay. Thank you.
we'll pick up the pace.
All right, it's all right. No worries. I did hear it once before, but guess what? I don't remember it all.
So with that, the next slide is, in fact, this is 14. My eyes are on. The next slide is looking at the impact of hedging this EFA portfolio on the entire public markets portfolio. And here you see the reduction in risk of hedging everything, 18 basis points, an increase in return of about 19 basis points. And again, if you exclude yen, looking backwards, it improves the whole dynamic fairly significantly. The risk reduction is now 23 basis points, and the return is 24 basis points. And then finally, we look at the news here is kind of interesting. We've now actually modeled in the Bar 1 risk system quite a few of your alternative assets. So using Burgess data now, we're modeling the equity, the private equity portion of the portfolio and the private real estate portion of the portfolio. It's not 100% coverage yet, so we've kind of grossed up what we have, the information we have on, say, 60% of the private equity portfolio, and assume that the bit we don't have coverage of is equivalent. That makes sense. So this is an attempt to say, including analysis of private equity and private real estate, what would be the impact of hedging the TRS EFA equity portfolio. So we're looking at the total plan, including pretty educated guess on the risk of private equity and private real estate. What's the impact? I just want to make one important point here. This is not looking at hedging the FX exposure of your private asset classes. It's just still looking at hedging the TRS EFA FX exposure. And whether or not it makes sense to hedge any portion of the private assets is kind of a separate discussion. As Mike pointed out earlier, it's such a small portion of your portfolio. It matters because the portfolio is so huge, but the lion's share of it is in the public equity portfolio. So with that, just to finish it, again, risk reduction of the total plan, about 16 basis points increase in return, coincidentally also about 16 basis points. Looking backwards, not hedging in, risk reduction would have been about 20 basis points, and the increase in return would have been about 21 basis points. So,
Can I just ask a question here that I don't understand? So when you just start with the FX, the IFA, you start with, if you take the IFA equities hedged except for Japan, the risk reduction is 1.65 and the potential return is 1.37.
You're on slide 12, John.
That was slide 12, thank you, yeah. And then if we go on and we add the, the risk reduction numbers get smaller because the denominator is bigger. But why does the potential return get a higher and a higher portion of the risk reduction becomes a potential return until it, in fact, the potential return exceeds the risk reduction when we look at the total plan? I don't just understand the math.
So that comes to the calculation of the potential risk return increase from dialing back the risk. Right?
And it's like
what it essentially assumes is that you're redeploying your risk appetite in the entire portfolio that you're considering. So in the developed markets case, in the IFI case, when you dial it up, you invest just in developed market equities. In the public markets case, you invest just in all the public markets. And in the total plan, you have the entire corpus to invest in. So essentially, all those additional asset classes have a better Sharpe ratio according to the lockdowns return assumptions and the borrow one risk assumptions. So you have a better, due to the better Sharpe ratio, you have
the unit
wider
of return per risk is going to be better.
Yes.
Got it. Okay, thanks for the explanation.
good idea to put them there. Sorry, I didn't mean that as a Snyder point. So on the last page, or last couple pages, we want to talk a little bit about mechanics of hedging and some of the considerations that need to be taken into account in kind of constructing or implementing a hedging program. So on this, I'm on 16, and on this slide, I really just want to get one important thing across. Some of the arguments for hedging that we've gone over may seem relatively complex. The mechanics of implementing a program are relatively straightforward. Okay, it just consists of a technique which is called rolling FX forwards. So if you invest in a foreign currency, you just sell that currency forward. And you say 1 or 3 months, very liquid FX in the currencies we're considering, very liquid FX forwards. And then a day or two before each contract expired, you settle it. Okay, so you've either made money or lost money. Your portfolio has changed in value, so that's kind of where the value is going. And once you unwind that forward, i.e. you settle it, you simultaneously replace it. So you just always have a 1 or 3 month FX forward in place equal to some fraction of the NAV in that currency that you're attempting to hedge. So that's a very kind of mechanical process. It's something any big bank or broker dealer does if they're invested, if they have exposures to things other than their home currency. Assuming that we have the right oversight of the whole program, we ship an agent the NAV of each currency we want to have hedged, and the hedge ratio, and by that I mean both where we want to end up in terms of how much of that currency exposure do we hedge, and we probably also think you want to implement it over time. So there's kind of 2 aspects to what we're going to call the target hedge ratio. Where ultimately do we want to be? And then given that we don't want to hedge 100% tomorrow, because it could move it, we haven't hedged in forever. So deciding to do it, I think it's like public equity. You want to kind of average in. So like you want to move into it over an extended period of time. So it's a fairly mechanical process to hedge, let's say passively, and we'll kind of spend a little bit more time talking about what passive means. And we think we can use the current infrastructure to come up with what the desirable hedge ratios are. Obviously, there's discussion which we're absolutely welcoming, involving Rokutan. Rokutan is going to be involved in, or managing that, we welcome. So we need to ship to an agent the amount of the exposure, the NAVs, and it needs to be, so it obviously needs to be adjusted based on every time additional monies are invested in a currency or capital is removed. So we need to put in place a program where we just ship the NAVs. We automate shipping the NAVs to an agent, every night. Once the NAVs change by some threshold, the amount of FX forwards in place will either increase or decrease in line with the change in exposure. Exposure could change based on, again, us increasing the investment in that currency or decreasing it, or just the market value of the investment changing.
Miles, in the potential return numbers that you've put throughout this deck, have you factored in the cost already? So this is the expectation after we've paid whatever fees we're going to pay to whatever agent is going to do the hedging for us?
Yeah, in the optimization that we set up in the Bar1 platform, we factored in, Nick and I got on Bloomberg and looked at what the bid offer was on the FX forwards in each currency, and we put that in as essentially it's a component of the analysis, but it also included, so sorry, let me step back and say one more thing. We already have, or you already have an agent that executes spot FX transactions on your behalf. So Russell, every time an additional investment is made in Europe, money comes in dollars. It's exchanged for the euro, the currency in which the investment is being made, by Russell. They execute an FX transaction on your behalf. So there already is an agent that we've actually looked at the contract, and we could decide to use that agent to do the forwards. Finally, to answer your question, and yes, we got an estimate from Russell as to what their cost of acting on our behalf in this capacity would be, and that is also factored in.
Great.
Now, and that being said, we need to spend more time with Rokutan looking at the bid offers we have assumed. We got on Bloomberg and looked at them a couple different times. We've actually now started asking Russell their view as to what the expected bid offers are. This is just a side note. Interestingly, they thought the cost bid offer in the Korean won, for instance, was much lower than we had assumed. We've never assumed that you would hedge the Korean won. Russell actually suggested the bid offer is so low, given the volatility, you might want to consider. So that's another issue we need to discuss. We're not ready to make any kind of recommendation on that. Okay, so fairly mechanical to implement. Important decisions prior to implementation. Once there's an agreement, if there is, to have as to what to hedge. Actually, hedging it is, I don't feel that complicated. So again, the final page is just what are the issues that there needs to be more consideration given to come up with a recommendation. Which of the currencies should be hedged? What's the timing of putting a hedge in place? What is the implication in terms of liquidity? I mentioned that if a contract moves against you, we have to find cash to settle it. What is the impact on that, on the liquidity of the fund? I think it's less of a concern if we're talking about public markets. If we want to raise money, we just sell some of the thing that's being hedged. In the alternatives, obviously there's a lot less liquidity in the thing that we're hedging, so there's probably pretty strong arguments that there should be a different analysis as to whether or not there should be any hedging of private market exposures. The other thing that would need to be part of a recommendation that we would come to you with is the rebalancing range. If we establish some target, where do we want to be and at what point in time, how long do we want to take to get there? We probably don't want to change the hedges for a small movement in the NAV that we're hedging. So like all the other aspects of rebalancing, we probably need to specify a rebalancing range and get your approval. The remaining issues we've left in here are, should we look at hedging privates? The second to last thing, consideration, basket clause utilization. We have talked to OGC, who thankfully have come back with what I think is the right, one with the hoped for conclusion, which is that the only utilization of the basket clause that would be a consequence, it's just the market value at any point in time of the forward. It's not the notional value, it's just the market value. So the bottom line is that a hedging program would not use up much of your black basket clause capacity. And then finally, the thing that I mentioned before, rather than involving BAM in any execution of the hedging, preliminary discussions with two different entities that could perform the function, that would be fairly straightforward. And that, sorry, if there are any questions.
More questions? Good. Sorry, I got a couple. I just want to be clear to follow up on the point that Dave made. When you say execution through an outside manager, you say we currently utilize an outside manager to do just not the hedging but the exchange. Would the hedging require a different outside manager than the exchange manager? And if so, is that cost built in?
So we don't make a categorical statement that we should use Russell at this point, but we actually think our initial conversation suggests they're absolutely capable of doing this. And we did get an estimate of what they would charge for doing it, and that estimate, as I mentioned today, is built in.
So we might actually end up doing an RFP or a search, and then it could end up being Russell, could be a separate manager. And is it potential that you have one manager that does the foreign exchange and a different manager that does the hedging, or that wouldn't make sense?
Well, we just think it's an execution of a foreign exchange contract. We don't know. I'm not trying to opine on what the ACO is going to say.
Yeah.
Okay. But my personal perspective is it would make sense to use the same entity.
Okay.
They are widely thought to be very competent, and they are one of the people that do implement passive hedging programs often use Russell.
Okay.
So we think they would be a perfectly acceptable choice, and we have not had conversations with the ACO. We have with OGC, and actually it turns out under the existing contract, the initial review of the initial contract suggests we could actually just ask them to do this without going through a lengthy procurement process.
Second question, regarding the private asset classes. So we have a fund coming in front of the board at the next SIM that is a private equity fund investing in foreign markets that gives you an option of dollar denominated or euro denominated. And the system's recommendation is to do the dollar denominated. My question is, if we were doing hedging, would it make more sense to invest in a fund like that in a local denominated fund rather than the dollar denominated fund? Because I don't understand actually, if we do the dollar denominated, then presumably the capital calls come in dollars.
Yes, they do.
And then the fund returns the dollars, but does the exchanging itself, and may itself, I don't know,
Have
do
a hedging
hedging.
strategy.
Right. So I'm just wondering whether in that sense it makes more sense to let them do it or for us to do it.
So
if we ended up doing
you definitely touched on one of the complexities of hedging privates. Right? Some managers have seen it, some don't. We haven't done. Again, it's a small fraction of the exposure. So this is just my intuition or preliminary thoughts, and my colleagues can absolutely chime in. We'd probably just let the manager do it. Would be my knee-jerk reaction.
Okay.
I would concur, and it gets down to the liquidity management. So when we settle a hedge, some months we're going to make money, some months we're going to lose money. On the months we lose money, we got to give them capital. So if BAM, Russell, whatever that entity is doing it, we got to come up with money, and that money should be funded in a best practices out of that asset class. And to sell private equity is there's a massive bid-offer spread, and that's not something we want to be in the business of doing.
And the thing about the cash flows in private equity is they're lumpy, right? You're giving it up and you're getting it back in big lumps, and they're not predictable.
Changes in NAV or
Right.
quarterly, maybe the manager has better
Well,
insight.
quarterly with a 3-month lag.
Yeah,
blah,
so
blah,
I-
blah.
I
So we'd
think
rather
it's just-
leave that to the manager.
All right,
to do.
that's
If
a
they
good
offer it,
answer.
I think it's
understand.
fantastic.
Okay.
Now the caveat there, though, here, this is actually, I think, relatively important. So private real estate is becoming increasingly defensive, right, in terms of the new investments that they're recommending. And they are starting to, they're increasing, their suggestion is to increase the investment in private real estate funds that invest in debt secured by real estate. Okay. I think when we get to analyzing whether it makes sense to hedge privates, I would think that the one thing, it is, so backing way up, John, where there is an absolute consensus amongst, I believe the consensus amongst large investors is one should hedge foreign currency fixed income.
Right.
That's just
Why take currency
everybody
risk
thinks
on that sort of investment?
And if you remember, one of the reasons that got us looking at this was Joe Alejandro raising his hand at SIM and saying, what about a sterling? He was specifically referring to a sterling denominated private real estate investment that we were asking the trustees to consider. So what about hedging the FX risk? And then to some extent that's one of the things that got us started on this whole exercise.
Okay.
And we agreed with that, actually, that is something we probably should do. Well, it's such a, we haven't prioritized hedging privates because it's such a small percentage of the portfolio, but when we get to looking at it, that would be top of the list of things where I think it would make sense. If the manager's not doing it, we should.
How much, it's interesting because you talk about EFA equities. Do you guys, off the top of your head, you may not know, how much foreign denominated, and it's all developed, we don't have emerging market debt, but how much foreign denominated public fixed income do we have?
Zero. Well, sorry. So your question is public markets?
Public fixed income, foreign, non-dollar denominated.
Very close to zero.
No, that's not true.
I
Is that
thought
true?
believe it is.
There's a tiny bit in the tips. Tiny
That's
bit
it?
in the tips.
On
You're
slide
saying
page.
that we don't have any of the, what we used to call 4+5, right?
There might
it on
be
there?
some modest
Point
non-US
out.
exposure in the OFI program, but it would be small.
Only
I think-
so we don't have any public.
There's what you might, and I think it's
Is that
very. In fact, in
euro
U.S. fixed income indexes,
Oh, fixed income.
there's a lot of
Fixed income.
non-U.S. issuers. They issue in dollars though.
Uh-huh.
So you might see issuers.
We're
You
not
could see.
buying, we're
You
not
could.
buying any sovereign.
We're not
debt,
buying bonds,
even-
we're not buying
we're not-
GGBs, we're not
no.
buying any of that stuff.
We're not.
That is our number.
But there might be non-U.S. issuers, but they're dollar
Actually,
securities.
John, on page 3, yeah, it actually
Oh,
gives
okay.
it to you.
Lays it out.
3 basis points.
3 basis points. Wow. Okay.
And that's UK tips.
U.S. fixed. Global fixed. Wait, it's 30 basis. Oh, I see. It's all in dollars. I got it. Okay. Oh, and there's 3. Oh, that's private real estate.
Oh, Brazil. But they're dollars. They're dollar issued. Could be a soft non-U.S. sovereign issue, but they're in the act.
Yeah, I don't even see. Where's the 3? Oh, I see. U.S. fixed is 3 in euro. I got it. Okay.
I thought it was UK tips, I guess it's not. Must be
So
some
we actually used to have some more. And we got what?
I believe a reference was made to that there are a lot of non-US issuers issuing in US dollars, but I think these assets are considered basket assets.
So we sold.
The global fixed income?
No, well, they are the global.
Oh, it's part of the 10%.
Yeah.
Probably the 10% international in.
You're counting against the basket.
If the issuer is not the US entity, then no matter the fact that they're issued in dollars, they're still basket assets.
Okay. I got it.
So we instructed, when we were looking at the basket clause and the
Yeah.
consumption of it, and doing that calculation more carefully, we suggested to the managers they should sell the dollar-denominated yen.
I'm surprised in private real estate there's not more either, but okay.
Wait, it's going to ramp up. Their target is, what, 15%?
No, we've just made a
Yeah,
number of
but not
commitments.
necessarily non-dollars.
Exactly. And they're
Yeah,
close to
sorry,
their
sorry.
15% target, so I don't think the recommendation is a meaningful ramp up, but they will be looking at private debt opportunities in foreign denominated.
And I wasn't suggesting we do something about that right away, but just if we're going to look at privates, that's where we would look first.
Agreed.
Okay. Other questions or comments for Miles or Bam on the currency?
So I think what's next is we come back to you with a more fulsome, in conjunction with Rokutan. We'll continue looking at this with Rokutan, and we come back with a more fulsome and specific recommendation. And that's the plan.
Right, I mean, do we have consensus that BAM should take a deeper dive into this topic with Roboton?
Oh, absolutely. Sure.
Definitely.
Okay. And do you have a sense of timeline? I know I asked this in the summer, like when you think you might come back with such a fulsome recommendation as one of
No,
Miles's.
not the September sim, but
Yeah, well,
perhaps,
obviously.
but perhaps October, November sim.
Okay.
We have to coordinate with each consultant and get to the same place, but I think you can tell from this that we have an opinion.
I'm sorry.
That's like
I've
herding
monopolized
cats, right? You're coordinating with multiple consultants.
That's Bam's whole job.
Was there a question for me, Miles, or?
No, I've monopolized the conversation. If you guys had any?
No, I think you did a fine job, and where we had thoughts, we certainly would jump in. We've discussed with you. I think it's thoughtful. We have some clients who are doing some hedging, so it's certainly more popular if you go back 10 plus years ago to do hedging, but it's not. It's certainly with merit to consider it. So I think you've looked at it comprehensively in the right way, at least the way we would want to, which is to look at, and you've not, importantly, even though historically there's been a return benefit to hedging, that's not part of the justification for hedging, as we understand the argument you've made, the position you've taken, which is it's risk reduction and redeploying risk, which we would support as well as the approach. So, yeah, we're happy to work with you to bring this forward, in the next couple of months.
You're looking quizzical.
Me?
No, I'm rather sorry.
Let's bring it down a notch to my level. I mean, you sound like, at the beginning I thought you weren't trying to sell anything. But I
apologize.
I realized that, hey, and you're doing this across all funds, I would imagine. Okay. So
The 5 systems?
Yeah.
Yes. Yes.
So let's bring it down a notch. And say I've been traveling to Europe for the last 10 years. Go to Europe, go to England, where they have the pound sterling, and then I'll go to Europe. And every year, sometimes the euro is high, sometimes the dollar is low, sometimes the other way around. And what happens if I plan to continue going to Europe for the next 10 years? So a 20-year period. So some summers are great for me, and some summers are not so great for me. And they kind of equal out. But there's this travel company that says, hey, you can pay a fee up front to protect the value of your dollar when the time that you have to pay more for the pound sterling. So convince me, Miles, that I should pay this travel company a fee to just protect my dollar value, when over the last 10 years, it's been up and down, up and down, up and down, and it just seems to equal out with the value of the dollar and the value of the foreign currency.
So that's...
In simple terms.
Yeah, but that's interesting. I mean, there's a couple of different things, I think, that are embedded in your question, or could be thought about in the answer of your question. And one of them is, I'm moving slightly away from your analogy. You pay essentially an option fee to some travel agent. But just, should a long-term investor, like like you, like this system, consider hedging. Well, do we believe the currency is mean reverting or not? I personally don't think every currency should be assumed to be mean reverting. So that's an argument for hedging. But the other thing is, are we really a long-term investor? And what I mean by that is, obviously we have money which is going to be invested for a long period of time before we need to sell assets in order to pay beneficiaries. But we often term ourselves as being a long-term investor, but we definitely care about short-term investment returns. So we're kind of like a deer. You know, we kind of got we have two objectives. We care about long-term return, but we also care about short-term returns. We talk about them, and it receives press, and if we don't do well, you know, it's viewed as negative, even though our objective may be to invest for a 20-year horizon. So
you're saying it would be bad press if for one summer the market.
Well, I'm not just saying it's press, actually. When we do the asset allocation, we're assuming, we make an assumption about the volatility of the asset. I mean, there is short-term volatility that we do seem to care about. Sorry, saying saying it gets into the press makes that sort of seem like a pejorative. You know, it's not just optics. We do care about.
Miles, why now? Is it because of the Brexit vote, or why now?
Sorry?
Why at this time are we considering?
I think there are lots of academic arguments that we've reviewed that suggest broadly hedging makes sense. The other thing I would offer up is a number of systems have started to implement a hedging program and regretted it and have pulled the plug at exactly the worst time. And CalPERS is an example.
CalSTRS?
CalPERS.
And what about CalSTRS?
I'm not aware of where they stand on this. CalPERS put something in place. It went against them. They had losses. Or they had to settle the hedges, and the size of the payments that they had to make to settle were large enough that they looked at the whole thing again and pulled the plug at exactly the wrong time. Right? And now they're looking at putting an FX hedging program in place again. So the thing that I would suggest is, if you should decide to do this, implement it over a fairly extended period of time. I personally would be, because you're right, I am kind of selling something. I would be horrified if Dan, in conjunction with the consultants, convinced you to do something, and then we piled into it next week, and the FX rate moved against us dramatically, and we had huge cost to settle the hedges. So I think it should be, in answer to your why now question, I don't think it should be now. I think it should be over the next 3 to 5 years implemented.
But ultimately, your goal is to have the 100% of that 19%.
Even that is an assumption that we want to make sure we're on the same page with as
you said a term several times, FX forward.
Yeah.
And I didn't understand what that meant.
Sorry, but let me go back to an important thing you raised in your last remark, 100%. The very interesting thing about the analysis, I'm not going at the highest level, but an interesting observation is that you get more than half of the benefit from hedging only half of the exposure. It's not a linear relationship. So if the determination was to do 50% to get started, I personally think that would be fine, and I'm particularly enamored of it if that was the conclusion, because you're getting more than 50% of the benefit by hedging 50% of the exposure. And I'm sorry,
Miles, did I hear you say you would have to sell assets in order to hedge? Sell at a current?
The remark I was making. So sorry, going back to let's start with FX forwards, and then if we buy €100 of Daimler, say, well, what would the hedge be? Well, we would just sell €100 forward $4. So your system makes an investment, buys some Mercedes stock, it pays, so it now has an asset which is denominated in euro.
TRSNYC,
So what we would do,
opposed to what we have now, which is in dollars.
well, let's say this is the first non-dollar investment you made, and it was in Daimler Benz, and it was worth $100 or 100 euro. So you would now have an asset that's worth 100 euro. How would we hedge that? We would sell 100 euro forward, right? And then that's a good hedge until the contract matures. And then the instant that we settle the contract, so in a month's time, let's say it's a 3-month forward, in 3 months' time, that forward, when you sell a currency forward, you sell it at the forward, it has on day one no value. You agree with the bank what the forward FX rate is, and you sell the currency forward at that rate. And so tomorrow, assuming the FX rate doesn't change, that contract has no value. But over 3 months, it's either going to have a value, it's going to have a negative value, or a positive value. And the bank that you transact with is going to ask you to settle up, give us the money, or they're going to give you the money, depending on which way it goes.
An FX forward is just a vocabulary in the FX market for doing a trade to do a hedge. It is, I hate to say this, it's a dirty word, it's a derivative.
It's a maybe better, more. It's a contract, and the contract just says if the euro depreciates in value versus the dollar, you get paid that difference in value
Before it depreciates.
for owning that contract, because
At a certain
the
date.
stock that you own is less valuable in dollars. You get made whole by the bank that you have this
Because we
contract
have it in
with,
euros.
because you have the forward contract, which trades euros for dollars. That's all it does. And
Yeah.
and I
And so
really,
the instant, I'm sorry.
well, I was going to come back to your construct earlier, Tom, which I'm not sure we completely got to, which is if you were traveling to Europe every year and the risk of the euro dollar exchange rate is significant enough for you as a consumer, where it's a concern, where you have to budget more dollars to go and travel, and that's onerous, it's a burden on you. If the cost of the insurance that this travel insurance company is offering you is cheap enough, that's the nature of insurance. That's all this is if it's cheap enough, if it's pennies on the dollar or less than pennies on the dollar, you might say, I'm willing to do it because this burden of the exchange rate is something that really bothers me. So if as you lower the price, and in the case of what BAM is actually already evaluated and we completely agree with, is the cost of insurance, the cost of these contracts we're talking about is very, very low, very, very, very low relative to the dollars we're talking about that you're investing in non-US markets. It's sufficiently low where the risk reduction you get is potentially more beneficial than the cost you're paying. We're talking about less than pennies on the dollar.
But where did I hear that? You lower the risk, but it's spread out to some other place, though.
Well, that's that. So, again, come back to your example of your travel. You might say what I have to budget in my travel budget, because I don't know whether the euro is going to be $1.50 or $1.20. I have to put more money aside, and if I can buy the insurance such that I don't have to, I can actually go buy more coffee, or I can buy a bottle of wine, or whatever it is you want to buy with that.
Maximize your reward.
Excuse me.
To maximize the reward for the risk.
Exactly. So whatever the price might be, you can buy clothes.
Our reward would be the higher rate of return.
So in this case, we're talking about as an investor, we're not spending money on clothes, wine, coffee. We're spending money on extra risk and trying to get better returns. It's the same. It's exactly the same equation. So it's a wonderful example that you brought up, and it's a question of whether insurance buys you enough risk reduction. If you're a homeowner, if you're insuring yourself against going to the hospital or in medical bills, all these insurance examples are just it's a risk reward equation that we're all playing out in our heads every day. Do we want to buy the insurance? And this is now for an institutional investor. It's the same kind of analysis that we're doing, and the cost of the insurance in this case is very, very cheap, so it might be worthwhile buying. Is that Is that helpful?
Oh, yeah, real helpful.
It was much better response than mine.
Let me just raise one more point, which I think you guys have raised with me privately, which is that if we do move forward with a FX currency hedging program, it will likely change the capital markets expectations and the correlations between our international portfolio and the rest of our portfolio, which may lead to a need to revisit our asset allocation because the expectations and assumptions that we used to do our asset allocation 2 years ago may now may not be reflected in the new strategy. And in other words, we may actually want to do that in conjunction, is as we're examining whether to do the currency hedging and how to do it, that might lead to a desire to revisit the asset allocation.
In fact, we've discussed with BAM this exact idea, so it's a terrific point, and we, in those discussions, where we came to was, if we can get to a place where we agree on what the hedging strategy is with non-U.S. equity, or non-U.S. investments in the portfolio, then that is what gets fed into an updated asset allocation strategy, and that feeds into the overall strategy of the fund. So it does go hand in hand with those assumptions and those decisions. So it's something. What we're less excited about would be to let the model just drive the decision. Put into the model non-U.S. hedged, non-U.S. unhedged, and let it. We'd rather prefer to just make a decision on the hedging strategy, and then have that be the input into the asset allocation update that we do whenever that comes. Whether it's early 19 or sometime around then.
So
that makes sense.
I'm sorry. Thanks, Joe.
Please.
Going forward, you're going to get in touch with Rogaton, and you'll come up with a recommendation to us.
Oh, absolutely. We've already started discussing it with them, and we
In what time frame? In a month or two, or?
Yeah, this fall, and I think the idea that we've just been talking about is once that recommendation is sort of digested and acted upon, by the various systems, then sort of that decision might naturally flow into doing an updated asset allocation. And the timing of that in early 19 would probably make sense from a BAM perspective, assuming that that a new CIO might start around then. That person would want to be part of this process.
Is this all or none? I mean, can individual systems choose this, or it has to be across the board?
No, I mean each system has to.
It could be.
Yeah.
I think we know your system, of course, but we would think that given the size, any one of the systems individually is large enough to do this on their own. That's our sense, but
sure. We would hope that all of this
I guess the fees would be that much less if it was system-wide or not.
They're so low. They're so low to begin with.
All right, talk it over.
Yeah,
Get back to us.
And this conversation is obviously for the QPP, but I'm sure that I don't know if the TDA portion would have a similar process.
Yeah, there's certainly other considerations there, the assets being participant assets. We can talk about that.
But just as Rotan mentioned, the upshot of this is, if we do another asset allocation, we're going to understand their projections as to volatility and return are going to be part of it, and we're going to really understand what they think of the whole strategy when we ask them for different vol assumptions for EFA equity.
And we have assumptions already for non-U.S. unhedged, which is what we've been using,
Oh, I'm sure you do.
as well as non-U.S. hedged. Which means the beautiful thing about that is you can come up with any percentage hedge you want, because you just mix the two in any proportions you'd like. So we stand ready to kind of jump in on the asset allocation and also work our way towards that.
And the elegance of combining it with a strategic asset allocation is then you can redeploy the risk go through all those different scenario analysis and redeploy the risk where the best risk reward is according to the capital markets assumption.
Good. Okay. Everybody good?
Thank you.
Great.
Appreciate
Thanks
it.
very much. Very,
Thank you.
very informative and
Do
thought-provoking.
you guys might want to stay for the next two items.
You see everybody kind of sort of, but I guess I've got to. I don't want to yeah, the gavel is used all the time. For keeping the calcitrant lawyers in line.
Sure, it is.
What's next? Thanks, guys.
Miles, thank you.
Nick's last name.
Oh, Rada. It's actually Nicolay. And it's R-A-D-E-B. Rada. R-A-D-E-B. Rada.
Nikolai.
Let me just look at it here for a second. I don't think there's a C. Yeah, N-I-K.
You guys, you want to pass, do you have a handout for the next item?
We already did hand that
Here.
out, so people should have
It's in your
that.
file.
Might not be in.
I think I brought it, but I don't. Oh yeah, there it is. I got it. Okay, are we ready to continue, Dr. Millay? Do you need a break? Okay. All right, so the next item on the agenda is emerging markets, country screens, and guideline update. Mike, you want to take us away on this?
So, as a reminder, this has been a project we've been working with the board and staff on for about eight or 9 months. This impacts both the pension and the passport funds, so think of it more holistically. And what we've talked about is developing a review not only of the current process, but developing a process for how the board approaches investing in emerging markets looking forward. So in all these conversations, you might recall, particularly at the last meeting in June, the board asked Rokitan and staff to go back and develop an implementation plan. What would be necessary to move forward with changing the process so that TRS no longer excludes Russia, China, and Pakistan, but rather allows managers to make the investment decisions there. But in doing so, takes into consideration the beliefs of the board and the priorities of the board when making those decisions, so as to avoid any conflicts on those points. And those points are all something that we'll talk a little bit about when we review the draft statement of investment beliefs as the next agenda item. But I'll start by noting that that was, in our minds, the number one step in moving forward here was creating such a statement where the board outlines those views, those priorities, discusses not only the board's investment approach, but also looking at various risks, some that may go beyond investment risk, but certainly could impact investment risks. And so that's a very nebulous way of saying you need, the board, you need to come up with a concise statement that in some way guides managers to making the investment decisions that, as a board, you're comfortable with.
Can I interrupt just for a second? Because I just want to sort of put a pin on where we are. We're talking just about public market equities, and the prohibition right now is Russia, China, Pakistan. I don't recall how we decided just to sort of look at that side of things and not also the private side, which has a different set of rules, which I believe still is governed by the World Bank list of investable countries.
Is it World Bank or OECD?
I think it's the World Bank.
It's the World Bank.
Okay, thank you.
So, just before we move on, I was just, could, this discussion be taken to, as a consideration perhaps for private markets as well? Or is there some reason that this would just work in the public market area?
So I think it could, particularly to the extent which we look at the statement of investment beliefs. So that was developed while taking into account how the board board's priorities would get communicated across both public and private.
Okay.
To the extent there are changes to how you implement the process on the private side, we would look to BAM to help guide that, and
Okay.
potentially the other consultants.
Right. So this is designed for publics,
That's
but
right.
it may be workable after some further consultation with private.
Yes.
Okay, got it. Thank you.
And if my memory is working today, I believe we had that conversation where we were going to basically build it out for the public markets first,
Right.
and then see how we could adapt it for private
Right,
markets.
right. I just
going
wanted
forward.
to
Yeah.
So today the discussion is around this implementation plan that we've outlined, and this on the slide does not include every detail, but we think these are the high-level objectives that we feel are important to implement the process we've been talking about over the last several months. I mentioned the development of a statement of investment beliefs. The second point on this page states communicate with all passport and fund managers the statement of beliefs and revising guidelines where appropriate or where necessary. And I think what's here on the page doesn't do justice to just particularly how much work that maybe has embedded it within it. So I wanted to speak to that. And it says to communicate with managers. I view that more as a collaborative process that probably needs to be addressed. And so there's different ways I think we'll go about that, but in doing so with the public market managers, it's not just sending them a statement of investment beliefs in an email and saying, hey, we want you to think about this when you're picking stocks. Because we're coming from a place where there are countries excluded in the current portfolio, and there were reasons for that at the onset of this back in 2010. We want to make sure that it's very clear what the board's beliefs are to the managers and how the manager would consider incorporating those beliefs into their process and how they're constructing portfolios for teachers. So when I talk about, or note on this page, revising guidelines, it's not just removing the prohibition to Russia, China, and Pakistan. It's making reference to this statement, and I think having a conversation with the managers. The managers manage broader portfolios for their other clients, so they know what stocks they're looking at for their portfolios. We want to have a conversation with them about where the pain points might be. What about these beliefs may in some way conflict with the names they might otherwise consider adding to your portfolio? I think that's an important consideration. So that's a process that will take some time. And I think the reason why we want to be thoughtful about how quickly we do that and when we do that is because, as you're aware, there's an outstanding search for non-U.S. equity managers within emerging markets today in the pension. We're going to talk more broadly about other considerations for the passport funds there. And so we think that the rollout of this and the guideline changes should perhaps be in coordination with BAM for the searches that are going on. We wouldn't today suggest that you remove the restrictions, for example, and then make changes to the portfolio if in fact there's recommendations to change the managers in a few months. So that's something we want to be coordinated on, and we want to, as part of the search process and thinking about what the portfolios might look like, again, as I said before, talk to the managers about what the portfolios would look like and understand how this belief statement is going to be reflected in their process. I'll pause there and see if there's any questions.
Questions for Mike?
So
Yeah, let me just say.
Sure.
Yeah, I'm comfortable with what you just said. I was uncomfortable with this notion of sort of doing all this stuff at once in a, adopting investment beliefs, revising guidelines, hiring new managers, changing the composition of the international portfolio in terms of, index versus active and the division between emerging and developed markets and all that. It just seemed like, woohoo, we are like moving at breakneck speed here, and I was not ready to do that.
Yeah.
I think taking a more measured, deliberative approach makes a lot of sense.
Yeah, and I think, if we look at this, and the next part of the process talks about how we create an evaluation, a periodic evaluation process of the holdings. I think if we implemented this and in 12 months went through a process to review the portfolio and found that there were a lot of red flags or things that the board wanted to engage and talk with managers and portfolio companies on, I don't think that that would be necessarily productive. We want to try to make sure that there's no surprises 12 months from now when we do the review. We want managers to understand where the board is coming from and make sure that they're managing the portfolios in that manner from day one.
And one thing that I don't know if this is going to make things easier or more difficult than I just thought of is the BAM compliance monitoring system has certain tags. We currently have Russia, China, Pakistan as a tag, and at the next sim, for the first time, the compliance unit, as promised, is coming back with examples of any breaches that occurred during the preceding period. So I don't know how our compliance unit is going to be able to monitor compliance with a statement of
it becomes a more subjective process. And I think that's the important component of the, I'll call it annual review. We haven't ironed out specifically if it's an annual review or biannual review or more frequently. But there's not only is it hard to monitor in terms of what you specifically have here, but I think what you would find as well is that the scoring you get for these companies on different, call it ESG related factors, even that itself could be somewhat subjective. So this does create the need for more conversations with managers, help us understand why these companies are showing up as having additional risk from a governance standpoint. Help us understand why, if you're cognizant of those risks, why you still feel there's an investment case and that you're comfortable taking that additional risk. So I think there's a lot that goes on there. It's not just a review, but it's a review and figuring out how to prioritize those conversations with managers and then, if necessary, even portfolio companies.
Right. I mean, I wonder if there are any objective criteria that could be baked into this subjective process at all, just, or we say, we have a different conversation about the role of the monitoring that BAM does. Because, there could be instances where, there's a significant breach just because of sort of a misunderstanding of these subjective ideas that sits around for a year until we do an annual review. If we don't have, and I don't know how the system totally is designed, but I know that there are tags that are put in.
Yeah, I think it's something we need to
discuss.
To look a little bit more closely at and figure out in some ongoing way how much of the onus is put on a process where there's an active review and how much of the onus is put on a manager to say, hey, I'm considering investing with this company. It might flag. We should have a conversation about it and figuring out what's the process for sort of elevating those conversations.
And I wonder if, and I don't know, this is just popped into my head, if instead of a periodic review, if there are vendors out there, and we've spoken to some of them, that already have a process for scoring and reviewing, let's say, companies, whether that would be an extra layer of monitoring that we would want to employ on a regular basis, and they would be flagging. I don't know if that could work. If they could be flagging companies that don't reach a certain score, for example.
So, Suzanne, if I understand what you're trying to say is that part of the responsibility would be on the managers to have their own internal processes to know ahead of time, oh, this might be a problem, that might be a problem for teachers, or are you talking about something else?
I think I'm talking about something else. What I'm trying to say is that, BAM has spent a lot of time designing systems to monitor compliance compliance with the current restrictions and the current guidelines that are in place, especially for public markets. And that system, I believe, and I don't know if Miles knows more, sort of has certain tags. Russia may be one of them. If a manager by mistake or just unwittingly bought asset or bought a company or made an investment in Russia, a few weeks later, some kind of lag, we would know about it. It would raise a red flag, such you would report it to Alex or Miles or whomever, and then we would deal with it.
Right.
In this scenario, we're not giving managers, specific objective points that they can or cannot invest in. We're having more of a subjective general conversation. And I would think that compliance at BAM would ask, how can we monitor compliance with that? Like, what's the data point? And I remember some of the vendors that we've spoken about or spoken to score individual companies. And that's, a proprietary kind of database or function that they have. It's not something that BAM does currently, or maybe we do.
We do. Yeah.
We do, okay.
Yeah.
Doesn't NICERS do this already to some degree?
That's
It's a
through
totally
a
separate
vendor.
process.
Yeah, I mean, actually, no, not the companies. They do the countries.
Country. Okay.
But
But
you've
how do
got
we-
the ESG ratings from MSCI.
Yeah, when
right?
when we
BAM
got
does.
approval from the trustees to acquire the MSCI risk analytics system, we came back and said that a module we'd like to buy is all this ESG ratings data.
Right.
And to your point, that yes, there are certain practices like child labor.
Right.
There's all kinds of practices
Right.
where they do give us scores, and they do even come up with a total score.
So,
And we would absolutely share that with Roboton, see if any of this is of value.
right. So could that perhaps, be something that we bake into this, saying you have to have a MSCI ESG score of
Part of their communication
10,
with the
10 or
manager.
above to the managers, and then we could monitor if somebody buys a 8 or 9.
So we actually had a whole discussion about this last time. I happen to know this because I asked for the minutes for the last meeting coming into this meeting, and we had this whole discussion about this very topic after
I raised the
Sustainalytics
exact same point.
came in. And I think that there are,
Haven't wavered. It's
I mean, what's tricky about it,
Yeah.
I think, is to say to a manager, okay, we don't have this, like right now it's very simple. You say to a manager, don't buy companies that are domiciled in Russia, China, or Pakistan. If you say to a manager, don't buy a company that MSCI or Sustainalytics rates below X, first of all, the company ratings change, not even just annually, sometimes more than annually. Secondly, okay, so they take a big position in company Z that has a rating above X, and then 6 months later, their rating changes to below X, and then, oops, you guys are now out of compliance, but you were in compliance when you bought it, and we tell them they have to sell it?
Yeah.
It's tricky, right?
I don't think we want to go down that path.
Right.
Yeah, down that
Because
rabbit hole.
I think the intent is to let managers make the decision. Take this out of, let managers make the decision as to what the risks are, what the return potential might be for a specific investment opportunity, and let them make decisions based on that. And let's go through a process to monitor what the exposures, what those scores might be, whether or not that happens in an active way where we're filtering in, real-time MSCI scores, for example, or Sustainalytics scores, or if we're doing a periodic review to see where the hot buttons are, and then engaging with the managers to understand what their mindset is, why are they doing this, making them aware of what we're seeing, rather than trying to dictate the portfolio characteristics and the scores as part of this. We're not gonna. The intent is not to say you need to have an ESG score of X or Y.
But if we, in my mind, in the scenario that John just brought up, where we have a company that's at one level and then drops to another. It wouldn't be that we are necessarily out of compliance, but it certainly warrants, why did this happen? Is this something that we need to be concerned about and have the discussion about whether or not we believe that this particular company can repair that situation and return to our good graces, or whether this is something that is so detrimental to how the company is going to move forward that we do need to take some sort of action.
And I think that that's the right approach and way to think about it based on how we've outlined the process.
And the
Right, but
action,
there
by
has
the
to be,
way.
I'm sorry, but there has to be a trigger, you know.
Right.
My only concern is that, but if we didn't have an MSCI score or something to trigger our investigation into why that company's status changed, all of a sudden they're employing child labor as part of their business plan, or whatever it is. If we don't have that objective red flag, how do we even know that that's going to be seen and discussed and brought to our attention? So that's the purpose of our monitoring program, is when things change, we want to know about it.
But it sounds like what you're describing, and again, we had this discussion last month about the challenges of BAM or an internal monitoring program as opposed to hiring a third party to do the monitoring. And then, in other words, that might be the role that a Sustainalytics or an MSCI play.
Right.
And then also, what steps does it take? And I think what we have talked about is starting with an engagement process. But then who does that engagement? Does our Office of Responsible Investment and Corporate Governance do it?
An engagement with the company.
Yeah. In other words, if let's just say the scenario we've been talking about, company X has a score above the cutoff, and then it goes below, and maybe it goes below because evidence has emerged that they're using child labor or slave labor or something like that. And so then we say to them, hey, you're using child labor, what's the deal here? That's obviously shorthand for engagement.
I think it'd be great, just pick up the phone.
Yeah, exactly.
What's the deal?
We sick Mike Garland on them. And they say, oh, our mistake, we're getting rid of that contractor because they're using child labor, blah, 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 it won't happen again. Whatever, I don't know. But I think that the execution of this is tricky. And again, it's like we're really, I think, moving from a fairly, or we're proposing to move from a fairly simple on-off switch by country to a much more nuanced approach that may not lend itself to the same compliance on-off, you're either in compliance or you're out, that we currently utilize. And I think that part of what we would need to do here is figure out what would that monitoring system be, who would be responsible for it, how would they engage with the board, and so on. And like just for example, on proxy voting, we don't at BAM we don't delegate proxy voting to the managers. We do it ourselves. And so do we then? We have to make a decision. Do we delegate monitoring over this? Particularly in emerging markets countries, over the over the company behavior on issues that are important to us. Do we delegate that to the managers, or do we undertake it ourselves and then inform the managers, oh, we noticed that in your portfolio you have company X, and company X comes up as below our threshold on our scoring system, whatever MSCI or whatever we use. Can you talk to us about that? And so on. Again, and I think we have to map it all out so that we're not springing this on managers. And I think we have to map it out and document the mapping out, not just call the managers in for a chat, or not just have a talk with them when we're doing the manager selection process.
Right, and we have to map out how trustees can be comfortable that the investment beliefs are really being followed.
Right, but I also believe that this goes beyond investment beliefs, at least beyond the investment beliefs as drafted that we're going to look at in a little while, because those are very, very high level. They don't talk about slave labor, they don't talk about child labor, they don't talk about emissions or whatever other issues that we think are really unacceptable. They don't talk about government control, which is a big issue in Russia and China, for example, that we've seen in a bunch of the companies that make up a very large portion of the indices in those companies. So that how do we feel about investing in a? I already said this last time. People joked about how my emails about in a Gazprom that is the largest company in the Russian index that is controlled by the Russian government. I mean, that's actually very explicit. It's only about, I think it's less than 50% of shares that are publicly traded. So do we want our managers investing in a company that is controlled by the Russian government or by the Chinese government, or what have you? All right, now I've got multiple folks.
Or the American government.
Well, we actually, if there was a U.S. government company, we probably don't invest in it. Anyway, we can talk about AIG and GM at some other time in the past. Fannie and Freddie, okay, there we go. Anyway, what I'm saying is that I think there's some complexity here by moving away from a country screening that we really have to examine. And maybe that's what you mean on the slide by, revising guidelines for emerging markets managers, because those guidelines would, in the absence of having country screens, I think the guidelines might become a much more important document. And I don't think the statement of investment principles, at least as it's drafted here, which is high level, gets us to that place that we need to be.
Yeah, you could. The guidelines could simply, because guidelines do talk about monitoring and what you do monitor. It could speak to the aggregate characteristics of the portfolio. So we want an average score across your companies that you own that is better than the index. So it's not every single.
I don't know that does it.
I'm throwing out.
The index has no values attached to it at all. It has no investment beliefs attached to it at all.
Understand? I'm just.
Right.
There could be aggregate. Maybe the average score being higher than the index alone is not. Maybe it needs to be higher by some measure. But it would move away from. Right. It might move away from the individual screening and towards just. Generally speaking, like if you read the beliefs here, we favor, right? So we favor says we generally want companies that are better on these scoring than the overall market.
But it does say we favor, and then what we might want to include, but I'm not sure it goes into beliefs or in the guidelines, is we will not invest in companies that employ slave labor or child labor or whatever else we believe.
So maybe we should look at the I think some of these questions can't be answered until we know what the investment beliefs say.
I think we should just finish this item and then get to the investment beliefs. Because I don't think the investment beliefs is only about the emerging markets.
No, it's not, but I don't know, whatever.
So what I'm hearing though, I think is we need to, that people are, the board is comfortable with the process as it's outlined, but we need to further develop the portion of the process that looks at how we monitor, specifically how these managers are acting within the priorities of the board. So we need to focus on number 4.
Yeah, I feel like the guideline revision is also very important. And I actually am not familiar, I assume it's in our IPS, what our guidelines for emerging markets managers are today. Like, are there guidelines? There must be something.
I would sort of say that 2B should just become 2. That I would be more comfortable if we're working on developing the beliefs and the revision of guidelines before we communicate with managers.
Oh yeah. We can't communicate to managers until the belief statement is finalized.
And the guidelines.
Yes. Yep.
So I think the next steps are just guidelines and investment beliefs.
Yeah, I think that Mike is also saying that the notion of how we do the monitoring is also comes as part and parcel of that.
Right, exactly.
Like this is a whole package: beliefs, guidelines, monitoring, communication.
Yes. And
it's
we
all
need to
gotta
do
be
more work on that.
One holistic process that we're all comfortable with, as if we are going to move away from the screen. Right? Does that accurately capture what we're talking about? Okay?
Yes, sir.
And I would say, just on number 5, it's not just opportunities for engagement, but it's the engagement process as well, like how we think that would work. Because I don't believe, and I don't know if anybody here knows, that we've done a whole lot of engagement out of our corporate governance office with emerging markets companies.
And you know, there's a lot of capacity issues.
Yeah, exactly.
Planning issues that would have to go into
Right, but conceivably, some of the active managers in emerging markets might have that capacity.
Well, that, and we also talked about working with third parties to assist with that potentially, such as those we've met with the first part of this year.
But did they do first part of this year? You mean before the
First
summer?
half, yeah.
Yeah,
First half.
but they do engagement too, or they just do scoring?
No, their biggest focus is actually working directly with companies to examine supply chains to work on human trafficking and other issues.
Yeah, there's another one. Yeah. A lot of bad stuff going on. Seriously. Okay. All right, so does that clarify where we're moving on emerging markets? Okay.
So the belief statement, which we've already spoken about, this was circulated earlier this summer, and the version that you have in front of you, I apologize for some of the formatting, makes it difficult to read, but includes feedback we've received over the last couple weeks, which has been incorporated to this. Are there any, is there any further feedback that any of the board members would like to incorporate? Maybe what I should say too is, since this was last circulated, the things that are highlighted in blue and yellow is what was added. So there was an electronic copy that did not have what's shown in blue and yellow.
So let me just say that, when I saw this in the context of the emerging markets implementation plan, it concerned me because I did not think that there was enough meat on these bones to say to emerging managers, not emerging managers in emerging markets.
Well, I would say too, I know the last conversation was more specific to emerging markets, but this is something that we want to be cognizant that all managers are abiding by.
Understood, but abiding by what I believe this will be is a statement of what the board believes, right? It's not. I don't think there's enough there to communicate to managers. This is what you should be doing, and this is what you should not be doing.
Objective metrics.
Yeah. I mean, in other words, like the idea that they were going to get this and then understand which companies to buy or not buy, like that didn't cut it for me. Now that we're adding in the thing about guidelines with more specificity and a monitoring program and all that, that makes me more comfortable.
This is not intended to accomplish the specificity you described.
Right. So, let me just say, it's the process. The funds that I'm familiar with that have developed investment beliefs have carried out a much more extensive process than a draft being circulated and then remarked upon. So CalSTRS, for example, went through a very, very long facilitated process. CalPERS did that. At NYSERS, where we developed adopted beliefs in June, we started the process, I think, last fall with a subcommittee that examined investment belief statements of about, 15 or 20 pension funds around the country and, in fact, around the world. I think this is a good statement. I'm not sure it captures everything that should be in it. And I also think there's some things in it that aren't necessarily investment beliefs. So, for example, just as an example, the second bullet under under the third we believe, which is about expenses and fees, it says the second bullet, it's the one without any highlighting, says active management fees will be structured to take advantage of the system scale and to align interests between the system and the manager. Well, that's a practice. Like, that's not a belief. It's not like we believe. It's like, okay, this is the way we're going to operate, you know? So I think that the investment belief should be beliefs, the things that we believe, and not substitute for either an investment policy statement or, investment guidelines or anything like that. It should be a statement of beliefs, in my opinion. So I think there's some things in here that I don't necessarily think belong in the beliefs, and that there are some things that may not be in here that probably do. That's my thinking. So I would like to see us engage a little bit more iterative process before we get to a final product.
And I should just add too, I think the intent of circulating this earlier this summer was to start that process.
Yeah.
So that's good feedback, and I wanted to remind the board that we hope that that's transpired.
So in terms of moving forward, I think what we might want to do, but we don't have to, is have a little subcommittee, work with Rokaton to further examine this, and maybe it ends up right where it is now, or maybe we suggest some changes. Does that make sense?
I don't necessarily have a problem with that, but I want to make sure that we don't get sucked down a rabbit hole where 10 months from now we're fighting over a word the or at, in the belief statement. I want it to be, something that we're proud to put out there,
yeah,
and that we're comfortable with. But we're all very thorough folks, and sometimes that works to our advantage. And sometimes, many years later, we're still looking over the same documents, trying to figure out where stuff should go. So if we're going to do something where we kind of poke at this and prod at this, I'd rather it be something that we put together quickly, that we have by such and such a date, we're at least going to have a draft, we're going to have a version that we're comfortable putting out now, and that we can refer and revise later on if we feel that it needs to. Because just as we talked about with the emerging market screens that we're looking to put into place, those kind of hinge on this document being done. And so every delay with this is going to delay movement with that. And if anything, we've communicated to everybody here that we want to start putting those screens into effect as soon as possible, because our current Russia, China, Pakistan isn't cutting it, and it is leaving us out of a lot of opportunities for investment where we can bring returns in for the fund.
Right. And I think to Mike's point, he did put this out. We had some input, right? So we were fine with it. And you had some input as well. Is there anyone else who need to just put it out for a certain amount of time longer, a little bit longer?
So, my feeling, Deb, is that I haven't had enough time to really focus in on
So
it.
we'll just extend, yeah.
So, I guess I'm fine setting a deadline, so it doesn't go on forever.
Right.
And, we could do it for next month or the month after.
Let's do it for next month.
Yeah,
We
why don't
want
we
to do
shoot
it
for next
sooner
month?
rather than later.
And then maybe, I don't know, Rokaton, if I could ask you to be in charge of any edits that people submit, if you could put it in the document and then recirculate
Even
one
if you
document with everybody's suggested edits.
What we'll do is we'll take this as the starting point,
Yeah.
and anything we receive feedback on, incorporated into track changes,
Right.
like the IPS process.
Yeah.
And, yeah.
John, even if you take that second bullet and you just say, we believe active management fees should be structured to take advantage, that becomes a belief. You know, there's that fine line between a belief and a practice. To me, that active management fees should be structured to take advantage of the systems. To me, that's a belief. I don't know what other people would think about that. It's belief.
Fair, seems fair. Some of the others are worded that in exactly that way, and if you took out the "we believe" should be, it would turn into a practice. So beliefs can actually just translate into practice.
Sure. I mean, if you put, Joe,
Right,
we
but
believe
some ways
in front of each of those bullets, we believe.
Yeah, but to me, that's not the
Under
point. The point is
belief,
actually to
belief,
have
belief.
a statement of beliefs that's a higher level document, because we also have an investment policy statement. But
Right,
this
that's
is
the
kind
nuts
of
and bolts and the
right.
nitty-gritty
That's the
of
nuts
that.
and bolts. Exactly. That's a great way of putting it. So this ought to be sort of
But this
what our philosophy is,
What do you stand for?
what we stand for, and then in the IPS, I think you have stuff that's more nuts and bolts. That's my
That's a practice.
yeah. That's the practice.
Of your beliefs.
Facilitated workshop, past day workshop,
This was-
facilitate workshop help to get all the ideas and things on the table, finalize it, or we just do.
This was never intended to replace the IPS.
No, it's like the
This is the introduction.
the first
This is
part,
the
yeah.
introduction.
Exactly.
This is what we believe. You
Right.
think you can work with us, then we have the
I mean,
IPS.
I yield to that. I think it's necessary. Did you hear what Patricia
To
suggested?
have a workshop.
Or just one day where you get together, you work on it, you discuss your beliefs, and then you finalize it,
Right.
and you go.
Even half a day.
Even half of it.
Or 20 minutes.
Wow,
Yeah,
we must have more
Why don't we just do it now? No, not now.
But why don't we start the, you extend, send it out, extend it for a little bit, and then see if that's necessary. Maybe there's, not much more that has to be. I mean, I think that second highlighted thing, we favor strategies, that's like everything that we were looking for right there.
Where's that then?
Good conduct, fair labor practices, health and safety,
Which one?
that's
Oh, I see.
such an important part. So let's start that, maybe that's a good, as you said, a jumping off point, and then if we
Right.
need to,
We can
there's so
bulk
many
that up.
people that have comments, and maybe we could have a small,
So yeah, maybe what we'll do is I'll send this out to solicit feedback, and in the same email request availability for follow-up discussion, and then we'll talk about it on that discussion.
And come up with.
Good.
That's your workshop.
Right, there you go. Okay,
Good.
that works.
And maybe we can have a time frame by next investment meeting. We'll have this done. I don't want to drag
Yeah,
this
you
out.
can swing it.
I don't want to drag this out for months and
Keep in
months and
mind, some of
months.
us go to a lot of meetings, and there's also 2 Jewish holidays this month, so it's a tough month, but let's see if we can do it.
We can do
We
it.
have the RFI thing, we have a lot. So, anyway, let's
While
try.
you're fasting from your Yom Kippur.
It'd be perfect, yes.
And then I would just add on the emerging market screen and timing with BAM, you referenced, the portfolio and the restrictions. We're in the midst of an emerging market search. Our anticipation is to come to the SIM in the spring of 19 with recommendations. Okay. So just to give you a sense of what we're working on, it would be, if we could tie the two together, it would be.
Okay.
Right, so ideally, if we have our revised guidelines in place before we do that search, then that will inform
The search is starting.
Not before we make our decisions.
Yes,
Yeah,
yes,
right.
yes, that would be
Right.
helpful. Okay.
Great.
Great. Okay. So I think that concludes the public agenda. Is anybody in disagreement with that statement? Okay. So I do think a motion to enter executive session would be in order.
come back. I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you, Deb. Is there a second?
Second.
Thank you, Susanna. Any discussion? All in favor of the motion to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. we're back in public session. Sue, would you report out of executive session?
I would, but first I'd like to just acknowledge that Camille Atiev, part of our group here at TRS, passed level 3 of the CFA. So congratulations to all of them. And in executive session, one manager update was presented. Consensus was confirmed on a specific private investment. We received a presentation from a service provider. There was a presentation and discussion of the international composite within variable A and therefore the international fund. And there was a presentation and discussion about the commission recapture program and trading costs.
Great, thank you so much. I believe that concludes our business for today. A motion to adjourn would be in order.
So moved.
Thank you, Deborah. Is there a second?
Second.
Thank you, Susanna. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Meeting is adjourned. Thank you very much.